Hello, everyone. Neil Wilding here with Stonewood Financial, and I want to welcome you to a very special Stonewood study group. And the topic today is going to be the enhancements that we just made to our total tax burden report. Now, total tax burden is our most popular report by far. We run stats on the site, and so we know that most of our members are running this report for every client they sit down with. We call it total tax burden. It basically just gives you a before and after picture on someone's tax situation with the IRS. It calculates their total retirement tax bill, and then it gives them an alternative, a peek into the future if they were to convert those assets to tax-free, what that number would be. And obviously the number on the right is always a lot smaller than the number on the left. It's a report that has just served all of our members well to help Roth conversion business as well as IUL sales and converting those IRA dollars to tax-free dollars. And so what we're going to do today, we're going to cover really some backstory on why we felt it necessary to update that total tax burden report. As the old saying goes, if it ain't broke, don't fix it. But we did feel compelled to go in and tinker with it a bit. So we'll get into the backstory on why we did it. Then we'll go into what the actual changes were. We had some Secure Act updates we needed to account for. We added an input to allow for a conversion period. I'll speak to what that means here in a minute. And then we also updated the tabular data. In case you didn't know, there are more than one page. There's more than one page to that report. And so, and there's some pretty important information at the back of it. And so we updated that tabular data. And then finally, I'll just kind of speak to, okay, so those are the changes. Why does it matter to you, the end advisor? So that's our agenda for today. So if you don't mind, we'll go ahead and get started. First, the why. Like, why did we feel compelled to go in and change a report that really wasn't broken? Really three reasons. First is the Secure Act was passed. And that Secure Act 2.0 changed the RMD tables on us again. And by the way, perfect example of legislative risk. If you're not using that terminology in your day-to-day conversations, I encourage you, write it down, legislative risk. It's the risk that Congress or the IRS changes the rules on retirement assets, and those changes negatively impact the amount of money that we will have in retirement. And the Secure Act 2.0, perfect example of that. They went in, changed the RMD tables, and changed the rules. And guess what? Those rule changes are effective immediately. And so we had to go in, and as of Friday, when you run your new reports, the total tax burden analysis will account for those RMD tables and changes. And so, it accounts for pushing the retirement age back, or the RMD age back to 75. It also accounts for those weird ages at 73 and 74 where, just kind of weird things happen. You take one and then skip a year and all that stuff. All of our software properly accounts for that. So that was the first reason we had to go in and just update the report to current legislation. Two is we had a common question that would come up. If you're familiar with the report, you know that it calculates the client's total taxes over their lifetime, assuming death at age 90. And a common question was, well, what happens, what would that number be if my client died at age 80, 85, whatever? And so what we decided to do is update the tabular data in our report to keep a running total. So now you'll be able to look at that report, and I'll show you that here in a minute, and see a year by year. It's at the back, so it doesn't impact the nuts and bolts of the report. But if you did want to say, oh, if my client died at age 83, this would be their total tax burden. And it keeps a running tab of all columns and then the summary as well. The third reason why is a common question that also came up is a couple of what ifs. I'll categorize them together. It's actually a few questions. One is, what if taxes change during the conversion period? This has come up more often because, we first came up with this concept of taking money out of an IRA and moving it to an index, 5-pay index universal life. And, it really became popular and feasible when the Trump tax cuts were passed back in 2017. And so back then we had a pretty good window up until 2025 when they expired. 2026 will be the first year where those tax laws have sunset. So that gave us plenty of time to execute a full 5-pay IUL conversion while taxes were artificially low because of the Trump tax cuts. Well, now here we are, it's 2023, and that idea is still strong as ever. But the question we get often is, well, okay, so if we start a 5-pay now, that means there'll be a couple of years of this conversion that's going to be subject to the new taxes, whatever they may be. Should we still do it? And our answer was always yes, but we didn't have the data inside the report to suggest why they should, because the report, as it was built, assumed all of the conversion happened in 1 year. And so that means when you change taxes in the future, it was showing the higher tax rate on the left-hand side, on the total tax side, but it wasn't fairly showing that tax increase on the right-hand side, because we were assuming that that entire conversion happened all at once in that first year when taxes were still low. So we made some changes to account for that. The other question we got was, well, what if there's a situational tax change? For example, if I'm converting assets and I'm doing so in a 5-year time frame, during the conversion, what if my client's in a higher tax bracket? And can you apply a different tax rate to the right-hand side number than you would the left-hand side number? Because of the conversion. Basically, we're saying, if I'm in a 22% tax bracket and the conversion drove me up to a 24% tax bracket, it wasn't really accounted for. That tax bracket drift wasn't accounted for in the report. Now, we spoke to it. We always said those numbers were general, but what we felt compelled to finally do is go in and make some changes so that the report was factually correct. So those are the whys, right? We want to update for the Secure Act. We want to account for people wanting to know what their total tax burden would be starting at different ages, not just 90. And then finally, we wanted to account for the reality that is, taxes could very well change during a conversion. And so let's true up the report to reflect that. And then, of course, also accounting for potential tax bracket drift. Okay, so what we're going to do first is I'm going to go in, I'm going to share my screen, and we're going to look at a report. And I'm going to start with the output and just kind of talk through a few of the changes to the output. And then we'll look at some of the inputs that have changed and then kind of talk through everything philosophically. And we'll probably do all of that in about 10 minutes. So I'm going to share my screen. Bear with me. And where we are now is in the client file. I'm just going to reset this so I don't get logged out during the session. And let's start with the output. And I see plenty of questions are coming in. Just because it's just me on this, I'll probably run through this and then we'll get maybe some questions at the end. So I'm looking at the output right now. And as I mentioned, this is total tax burden. This is our most popular report, and this is the most popular page of that. So some small changes first. One, you will notice that in the right-hand column here, this reallocate section, that's going to be your taxes if you go through with the conversion. You'll notice a slight change there. That used to say something about referring to a Roth IRA. And while Roth IRAs are very important, that's just one of the ways or one of the destination assets for a conversion would be a Roth. But we heard feedback from many of you said, well, can we just make that more of a general category? So we did. So the language on that now just says reallocate to tax-free. Now, for compliance purposes, we do have to reference that the Roth IRA is the vehicle we're assuming for this, and you'll see that down in the disclosure. But at least if you're just looking right at the chart, now it's a more broad conversation, is if you just keep your qualified account, if you keep your IRA, then you'll pay, in this example, $459,000. But if we convert to tax-free, and using that more general term tax-free, then it will pay $100,000. So that's change number one to the output. The second change, and I referenced this before, is the new page of tabular data. Now, My screen is small. I don't know if you can even see the numbers on this report. What I recommend you doing is just after this webinar, go in, just run a sample case and then pull the output. But what you'll see here now is a running a year-by-year analysis of what the client's total tax burden would be if there was a liquidation event. And so you'll see like the RMDs kick in at age 75, and you'll see all three columns now have a summary data. So we have a summary of the required minimum distributions, the total taxes they would pay as the money came out of the door of the IRA, right? So for that column, that's this number here at age 90 should match age 90 right there. Okay, and so you've got that column calculating the total taxes paid to the RMD. And again, it's year by year. So if you say, okay, what kind of taxes would I pay if it was 83? Well, then you just go to that, and your cumulative RMD, taxes due to the RMD would be at that point $98,000. But as we know, that's not the only way that the IRA is taxed. We're taxed on the way out the door of the IRA, but as that distribution is made, if they continue to save, these are the assets earmarked for saving, then we're now saving in a taxable account. So the money that was taxed on the way out the door of the IRA gets taxed again as it grows, and we continue the taxes on the taxable account. That's this column here, and that's what happens individual year, and then this is that cumulative number here. So if you're looking for age 83, right, here's your taxes paid to the RMDs, and then here is your cumulative taxes, right? So that's the cumulative number of this number and then this number. You follow me? Sorry, I'm jumping around a lot. And then the final number there is your if death. And then that one's not really on a table here, but the cumulative total here, the total tax burden, accounts for what that number would be if the client died in that individual year. So, so just so you know, that's there. It was a common question that we got. Most common page you'll use is still this one. This will be your total, the summary of your total tax burden. But if you're showing that to a client and they ask a question, well, this assumes I die at age 90. What would the total tax burden be if I died a year earlier or whatever? You just go to that page, go to the year, and then that'll give you your specific number. So anyway, so that is the changes that we made to the output. Now, what about the changes we wanted to make to our inputs? I'm going to go into the software again, and I'm going live here, so taking a risk. But I appreciate you bearing with me a little bit. We wanted to create a new input because of those questions that we got about, what would my total tax bill be if I converted and taxes increased during the conversion? Or what would my tax bill be if I pushed my client into a higher tax bracket? And so now what we're going to do, if you create a total tax burden report, all the questions are the same. You still label a scenario, you still put in how much money they would have in the IRA, and you put in taxes changing. But this is the new question. And the new question is, would you like to model this conversion over multiple years? And so what that means is, remember, the old version of the report just assumed that the entire conversion was happening in 1 year. Now, behavior didn't really sync up with that. Behavior was we're going to convert this over multiple years because we want to either spread out their tax burden for, the tax liability in the individual years to kind of minimize tax bracket drift. But also, if we're using life insurance, we want to make sure to maintain the tax-free nature. So we want to spread that out. In most cases, it was a 5-pay. So if you want to model, by the way, if you don't want to do anything, just keep it at no, and the report is exactly as it was before. But if you would like to account for this fact that we're going to convert some assets, you just hit yes there. And then it's just going to ask you 2 questions. Okay, what additional tax percentage do you want added? So if you're in here and originally I had gone like a 20% tax liability, it was changing in year 3, and then I went a 23, and those were my tax rates, just normal. So now I'm going to say, yes, I want to model conversion over 5 years. What it's going to do is it's going to add whatever number you put there to those tax rates above. So let's just say I feel like because I'm going of some tax bracket drift, I'm gonna have an extra 3% to added to my effective tax rate during the conversion. I put in 3%, I put in 5 years, and I hit run scenario, and that's it. And so what's the output look like when we do that? Well, here's what's phenomenal. So I ran an example before under the old way. And this was an example of $500,000, assuming a 20% tax liability. And then I assumed taxes would change at 2020 and 2026. And I assumed they went up 3% that point. And then I assumed taxes went up a lot more later. But during the conversion, we had some tax change. So the old report would said that you're reallocating to tax-free would cost you $100,000. Well, now under these assumptions, it's only $116,000. So yes, we are adding what in this case $16,000 to the right-hand side of the report, but now it's a more true number. It's more it represents true behavior because we are going to have in many cases some extra taxes we pay because of the conversion. So hopefully that makes sense. Now, what were the inputs that I used and what's that input page look like? Well, as I said, it was a 60-year-old. I assume $500,000. The growth rate was 5.25. I think that's our default now in the software. I assume 1.25 expenses. But here's what's different. That tabular data here, the assumed tax liability, I assume it's 20%, then it changes to 23, and then 26, and then at death 30. Those are just inputs. But what's different is this conversion assumptions. So I assume we're converting over 5 years, which means we're adding in an extra 2% to each of these numbers. But that's only during the conversion. So I'm going to pay 20% for the first 3 years of my conversion. But then in years 4 and 5, because I did a 5-year conversion, instead of paying 23, I'm going to pay 20. Sorry, I said that wrong. And so in years 1 through 3, instead of paying 20, I'll pay 22. And then in years 4 and 5 of the conversion, instead of paying 23, I'll now pay 25. And again, all of those changes result to an extra 16 grand in taxes divided by 5 years. It's a very small price to pay when you're looking at a macro tax situation. So hopefully that makes sense on the inputs and the outputs. I will just kind of talk through now a little bit about just kind of philosophically, like what were we trying to achieve here, and why are we doing these new inputs? And what could impact the change? Like what number should I put in that change taxes box? I would say really there are 3 things that are going to drive potentially higher taxes during the conversion period. First is tax drift. If we're in a 22% bracket, we push up to 24. That's could create a little bit more taxes to pay during the conversion. So that's one reason. 2 is IRMA. I understand, right, that our Medicare Part B and D premiums, monthly premiums are tied to income. So if we're adding more income during the conversion, and we have the IRMA calculation going on during that conversion, it could impact things. So that's the second reason. And then the third is just a legislative tax change, right? Congress, we always say Congress can change the rules. And so in the example that I just ran, I actually accounted for all 3 of those. Tax drift, I did some math. And so if you're wondering what numbers we should use here to account for tax drift, the numbers, a conversion of about $100,000, which is our standard example, right? If we've got 500,000 and we're converting 100,000 each year, that's an extra 100 grand of income per year added to the return. You're going to get between 1 and 4% effective tax increase to your effective tax rate because of the conversion. So the report's going to account for that now. Then that's just on average, right? If we're just jumping in most cases, we're just jumping a bracket, and again, only portion of that conversion is subject to the higher rate. So our effective rate goes up between 1 and 4%. And if you have any more specific questions on that, we've actually got an internal calculator we can run for you to tell you what higher rate to plug in there. to IRMA. There's a lot of conversation about this. A lot of people, a lot of tax planning going on saying, oh, you want to make sure to get your conversions done before they start calculating your IRMA monthly payments. And I feel like, yes, there's an impact, but if you're looking for like the greatest impact you could have to your effective tax rate because of IRMA, you're looking at about 0.5% and per bracket, right? So if you just jump one bracket, you're going to pay an extra 0.5% of total impact if you're quoting that as a tax and calculate it as part of your effective tax rate. So if you want to account for IRMA and your clients, remember that's not even really for all 5 years, because a lot of times IRMA, you know, if you start those conversions early enough, those IRMA payments aren't even really coming into effect yet. But if they are, I would add in maybe 0.5% to the effective tax rate. And then the third one is your legislative tax change. And I think that one's important. I think every example that you run should model some tax changes. And now it'll actually true up the right-hand side. But to me, you know, since it's 2023, and if we're going to do a 5-pay or a 7-pay, that means the final 2 or 5 years, whatever you're doing there, are going to be subject to a little bit higher taxes, because we know for every taxpayer, taxes are going up a little bit when those taxes sunset. And that's a good thing. We want that because it shows that taxes change and it shows that taxes can go up. And as a planner, we can get as much of our conversion done before that, but there's still going to be some leftover we're going to pay to the higher tax. But now the report is actually going to show a little bit more taxes. And so then the question becomes, okay, so wait a minute. So if now, under the way that Stonewood has done these changes, if I'm paying a higher tax on the right side, like, why are we showing that? And for me, I feel like it's just because what you do is you pick up, to me, you kind of eliminate all the yeah buts, right? When you go to show this tax report, a lot of times people are going to say, yeah, but I might have to pay higher taxes today because of that. And that's, I think it gives you the opportunity to A, be more accurate with your data, but 2, to say, yeah, but that's the point. We want to pay some more taxes today so that we immunize these assets going forward. We want to get these assets out of the line of fire from future tax changes. So we want to start this process as soon as possible and do it as quickly as we can and get these assets converted as quickly as we can. So now, that being said, even though this does introduce a little bit extra layer of calculation, we're still very much sales software. I won't think you'll ever confuse the Stonewood software with planning software. We are not trying to get the exact amount. That we are not tax planning software. This is we are, as Tyler on our sales team likes to say, that the reports that we have are openers. They are conversation starters. And we're going to show you and help your clients understand the tax liability that they have, and they understand that the change in that in current tax policy significantly impacts the success or failure of their retirement. And it's a tax risk, a legislative risk that we need to mitigate against. And the report just is meant to kind of shine a light on that. When you get into the planning process, there's going to be other software you can use to get down to the penny on what those numbers are going to be. But for us, what I highly recommend you do is use this report, use that concept of legislative and tax risk, incorporate that into your day-to-day conversations, and continue to use this report, regardless of whether you're using it just for Roth conversion business into an FIA, or if you're still using this for IUL sales, whether it's a 5-pay, 7-pay, whatever it may be. Continue to use this report with every client you talk to, because it's a level of analysis that just doesn't exist, and it immediately makes you different. And that is, it's paramount in our industry today of, advisors out there. What we have to do is find a way to be different, and by calculating and articulating the tax risk, legislative risk to our clients is how you're able to be different. So that puts a bow on this. I hope you continue to use this report with every client, every prospect you have coming in the door. As always, many of the changes that we made here to this report are because we heard from you. So I thank you for being a loyal member And thank you for providing honest feedback on what you like about the reports and what you would like changed. And then that will certainly lead to future updates and changes going forward. I'm really excited. This is just the first of a whole series of updates we have coming to the Stonewood software, to the marketing catalog that we have, to the trainings that we do. By the way, all of this this concept here, everything that I went over, it's going to be, if you're coming in to innovate here next week, all of our sessions are going to reflect that now, the changes that we've made. So you'll see how to plug the reports into your sales process going forward. If you're not coming to innovate here in February, we hope to see you in June. That's when the next innovate's going to be. And like I said, just cannot wait to show you what we have coming down the pipeline for you as far as software, marketing, and training. So as always, thank you so much for being a loyal member, and look forward to catching up with you very shortly. Take care.